Hello, everybody. It's Dylan Milks here for Wednesday, May the 30th, 2012. And I just want to comment about an item that was really been in the news today a lot, especially in the U.S. It's been all over CNBC today and really was the talk of the town, several articles online on the website written about it. And that is the fact that in the U.S., the rate of the 10-year bond fell today to its lowest point in history. So in the 250 some odd years that the U.S. has been in existence, their 10-year bond rate has never been lower than what it had fallen to today. And the yield, I believe, which was 1.63% over 10 years. So that's pretty disastrously low. And some people might think, well, what's the problem with this? Interest rates are falling. This could be a really great thing. It's going to mean mortgages are cheaper in the States, and it's going to mean that the economy is going to be helped. Well, I actually prefer to look at it a much different way. The fact that the economy is really, the global economy is really just kind of staggering along, barely out of the recovery stage, barely in the recovery stage. And you're looking at the problems in Europe, and everybody is just flooding the market, buying U.S. treasuries, U.S. bonds, U.S. debt as a safe haven, and thus driving the prices down. And with the way things are going here, I really suspect that even though today we hit the all-time low for the yield on the 10-year government bond, I really believe that in all likelihood we're actually going to see it much lower over the course of the next even over the course of the summer, because folks, there's really no answer in sight to the European debt situation, the debt crisis. And until there's either one of two things happens, until there's either a boiling point where there is the crisis, there's a crisis that actually erupts, that spreads globally, or until there's some sort of credible solution that at least on the surface looks like there's going to be at least the possibility of a long-term solution. People are just going to keep buying U.S. debt, and thus driving the yields down more and more and more and more and more. And sure, there are some good things about this. And number one, if those who are wealthy Americans or even wealthy foreigners who have money to spend, would be foolish to not take advantage of these ultra low interest rates, from anything, whether it be mortgages or any other type of loan like that. For example, if you're thinking, now with the 10-year dropping so low, that's going to have an effect also on the 30-year fixed mortgage. And right now, the 30-year fixed mortgage, the last time I checked, was about 3.95, around there, 30-year fixed. So that's even that 30-year is going to be falling quite a bit as well. I think as a 10-year continues to draw down. You're going to see even the longer term rates continue to be dragged down by that as well. So for anybody who is business savvy, who has some capital on hand, certainly now in the next 6-8 months is certainly going to be good times to be purchasing U.S. real estate, because if you can get a 30-year fixed for ultra low rates, and knowing that that interest rate is never going to change, that's a pretty good deal. Now, on the flip side, on the other side of the border here in Canada, as well as the European debt crisis continues to slowly inch along to a boiling point. The other countries, of course, is Canada. People have been flooding our country as well with money as well, and thus our bond rates are continuing to drop as well. Last time I just checked a few minutes ago before I came onto this video, and the 10-year Canada is about 1.87%. So we're about 0.25 or so 1/4% higher than the U.S. But if you look at the charts, we've really been dropping a lot lately, but really since winter. And I suspect again that as the European debt crisis continues to inch along, that that's going to drive down interest rates here in Canada as well. So, it certainly could be a good opportunity for people who, have capital to invest, to, get those those really low rates. But the only thing is that, at some point, this is going to all come to an end. And, the scary thing for me is that, as you watch people, average people, middle class people, people who are in the working poor, um, when they see these interest rates, they think, dollar signs get lit up in their head, and they start, falling into the temptation of taking on more and more and more debt. And this is the risk, I think, which we all have to guard ourselves against, is just burying ourselves in excessive amounts of debt, for this short period of time while interest rates are at record lows. Because the fact of the matter is that this is not going to continue indefinitely. And, who knows, is this going to go on for another 6 months, another year, or another 5 years? I don't know. But, my suspicions are that I suspect that this is going to go on for a couple more years, maybe 2, maybe 3 years, before things are really going to get shook up a lot. And, we need to really guard ourselves against that this temptation of taking on excessive amounts of debt while interest rates are at these record lows. Because what's going to happen when interest rates now even go from 2.5% on a 5-year mortgage to 5%, or 8%? What's going to happen? I mean, are you going to be underwater and having to get out of your house, or are you going to be able to handle it? So just a word of caution, I guess, to, let's just say, those people out there who maybe aren't aren't big real estate investors, but maybe who just own their own home and they have their primary residence, and that's about it. But just a word of caution there about, let's just kind of enjoy these low interest rates while we have them, but also keep in the back of our mind that this isn't going to last forever, and let's just make sure that we're not drowning ourselves in excessive amounts of debt while interest rates are so low, to the point of when the rates change, that we're all going to be, well, to put it lightly, we're all going to be screwed, because that's the same trap that the U.S. found themselves in back, in the early 2000s, which of course ended with the real estate bubble and the whole collapse of the housing market in the States, and really a lot of countries in the world, which we're still trying to dig our way out of this debacle here. So just a word of caution to everybody, and thanks everybody for watching, and hope to see you again soon. Bye for now. Take care.